Is SCHD dead weight, or is it the ultimate dividend machine? If you're like me and you haven't been living under a rock for these last few years, you've probably seen everyone and their mother talking about SCHD all over the internet. SCHD is the Schwab U.S. Dividend Equity ETF. Some people swear by it for the income. Others love it for the dividend growth. But at the end of the day, is it really just dead weight? Am I losing out on other opportunities because I'm investing into SCHD so much? I've been wondering about this more and more lately because everywhere on YouTube I'm seeing people say SCHD is done. It's over. It's dead weight. Is it worth it? So today I wanted to take a closer look and see what exactly is going on with SCHD and should I still be investing in it? Today we're going to dive in and take a look at the data, the performance, and more to see if it's still a worthwhile ETF to keep in my portfolio. Whether you're planning for early retirement, seeking passive income, or simply looking to balance growth and stability in your account, today we're going to break it all down. But before we get started, welcome back to the channel where we discuss how to grow our portfolios for the ultimate portfolio payday. Remember, I'm just some random dude on the internet, so always make sure to do your own due diligence before you invest any of your hard-earned money into the markets. What we discuss here may work for my portfolio, but it might not work for yours. So let's get started. Has SCHD fallen behind? What's the performance like in 2025? How has SCHD performed compared to the S&P 500 or QQQ or SCHG? As you can see here from the chart, year to date, SCHD is definitely underperforming. It's down just over 2% according to Seeking Alpha. In contrast, the S&P 500 is up 7%, SCHG is up 7.4%, and QQQ is up almost 10%. So naturally, some investors are asking, is SCHD still worth it? So looking at this example, this only factors in the price return. But if we factor in the total return, maybe that will give us a little bit of a different view. How does SCHD compare when we factor in dividend income for total return? Factoring in dividends for a total return, you can see SCHD is down still negative 0.2%, while QQQ is up over 10%, which definitely is challenging seeing this return on the year so far and how much better growth ETFs are doing than SCHD. But keep in mind, this ETF is all about income, not just capital gains, but is it enough to make it worthwhile to keep holding it? When you look at the total return, including dividend reinvestment, it still looks very bleak. Here's what makes SCHD so special. The dividend yield is 3.83%, while it has an expense ratio of 0.06%, which is the lowest among the ETF space. 10-year annual average return is 11.7%, and take a look at this dividend growth. As you can see, it's continually grown its dividend over the last 10 years since its inception. The holdings is what keeps SCHD consistently growing by investing in companies like AbbVie, PepsiCo, Chevron, Cisco, Merck, Home Depot, and more. It focuses heavily on consumer defensive sectors like energy, consumer staples, and healthcare. The kind of companies that keep making money through good times and bad. That's why SCHD didn't crumble in 2022, and it's also why it's not soaring right now in the current AI boom. So what is SCHD actually built to do? Let's talk about the tax efficiency of SCHD, which makes it a quiet superpower. SCHD's tax efficiency is one of the least talked about attributes for this ETF, but it's also one of the most important reasons why it fits into my long-term strategy. Here's some reasons why. Qualified dividends. Most of SCHD's dividend payouts qualify for a lower long-term capital gains tax rates, 15 to 20% versus 37% for ordinary income. It also has a low turnover rate. It has a portfolio turnover rate around 29%, which reduces taxable events because it's more of a passive buy and hold strategy with some active management. The third reason is called tax loss harvesting. In years of underperformance, SCHD can offer tax harvesting potential while still keeping your dividend stream alive. Just be careful when it comes to this, as there are rules you need to abide by. So based on my experience, here's who SCHD I think would work for. If you're near retirement, You want dependable income with reduced volatility. For people that are risk averse or don't like the ebbs and flows of the stock market, if you have a hard time sleeping when the stock market goes down, SCHD is definitely something you want to keep in mind. If you're a long-term passive income builder, you want income that continually builds while you sleep, SCHD is perfect for you. When held in a Roth IRA, you can maximize the tax efficiency. SCHD's dividends grow and compound nearly tax-free. If you hold it in a taxable brokerage, it's still more tax efficient than most other ETFs. I hold it in both my Roth IRA and in my traditional brokerage account. So now we've come to the point of what I really wanted to discuss today, and something that I've been really thinking about is growth versus income. That's the real portfolio question we all have. If you're under 40 and only buying SCHD, you're probably leaving some serious growth on the table. As we showed earlier in the video, QQQ, SCHG, even the S&P 500, you're getting an annual return of somewhere between 10 to 18%. And if you're not investing in those and only investing in SCHG, you might be doing yourself a disservice. Looking at QQQ, it's up 113% in 5 years. SCHG, almost 126%. Those are massive gains that you would be losing out on if you only invested in SCHD. But where does SCHD fit in? Remember, it's not a replacement for growth, but it's simply a complement to a 3-fund, 4-fund, 5-fund portfolio, whatever you think works for you. If you're 20, 30, early 40s, and you're only investing in SCHD, you definitely want to consider adding some growth to your portfolio to make sure that you're not missing out on income that you could be earning later on in life. You're probably over-indexed, and you might want to consider rebalancing. So growth, you have SCHG, QQQ or QQQM, VUG. For income, you have SCHD, of course, but you also have ETFs like DGRO, VYM, or you could do a broad market, VTI or VXUS. So the bottom line, is SCHD dead weight? Is it something that I want to sell off and remove from my portfolio? Probably not. It's doing exactly what it was built to do. I buy it for the dividend growth aspect, and continually year over year, it's done nothing but increase their dividends. My plan is to hold it for another 20 to 25 years until I'm ready for getting close to retirement. It delivers reliable, growing income through all market cycles. Sure, in a tech-dominated market, it's not sexy. It's not really having the growth that we all want, but ultimately, it's still paying those dividends every single quarter with increases every time. And in a market crunch or pullback, it's going to continue to weather the storm. If your financial goals are financial independence, passive income, long-term wealth building, SCHD definitely deserves a spot in your portfolio, but just don't make it the only one. Pair it or mix it with growth or broad market ETFs, and you've got a strategy that will make you money for years to come and weather any market. So in my book, it is an ultimate dividend machine. Thanks for joining me today. Drop me a comment below and let me know if you invest in SCHD, and if you don't, why not? Also, if you're new to dividend investing, check out the links in my description below. Learn about the 7 rules of dividend investing for new investors, or check out the blog. Until the next time, have a great one.